The fiscal deficit target is perhaps the most important number in any budget-making exercise. In simple terms, fiscal deficit is the difference between the expenditure and revenues of a government when the former is higher. For the fiscal year 2022-23, Finance Minister Nirmala Sitharaman has targeted a fiscal deficit of Rs 16.61 trillion or 6.4% of the nominal gross domestic product. The assumption is that nominal GDP would grow by 11.1% next year. The gross tax revenue for FY23 is seen at around 9.6% on back of the 11.1% GDP growth assumption. Analysts say that this is a rather conservative target which could be easily met, especially given that as per the current year's revised estimate, nominal GDP for FY22 is around 18% and gross tax revenue growth is seen at around 24%. However, Revenue Secretary Tarun Bajaj told Business Standard that if one removes the excise duty component, which is expected to be much lower next year, the revenue growth rate for FY23 is around 14.5% and revenue buoyancy is expected to be around 1.25. Non-tax revenues for FY23 have been pegged at Rs 2.69 trillion compared with FY22 revised estimate of Rs 3.14 trillion and budget estimate of Rs 2.43 trillion. A big surprise has been the budget estimate for divestment next year, which is just Rs 65,000 crore. The government has many pending privatization plans it would want to push next year, including Bharat Petroleum, Container Corporation, Shipping Corp, Pawan Hans and others. The total FY23 budget size is pegged at Rs 39.4 trillion, a 4.5% increase over the FY22 revised estimate of Rs 37.7 trillion. Of this, revenue expenditure for FY23 has been budgeted at Rs 31.9 trillion, almost the same as the revised estimate for FY22. The big jump comes in capital expenditure. The CapEx budget estimate for FY23 is Rs 7.5 trillion, a 24.6% increase over the FY22 revised estimate of Rs 6.02 trillion. The FY22 CapEx budget estimate was Rs 5.54 trillion. However, the CapEx target for next year also includes Rs 1 trillion to be given to states as a 50-year interest-free loan for their capital expenditure needs. There has been a cut in allocation for Narega and healthcare in the coming year. As per the government, the former is because it is a demand-driven scheme and the latter because the vaccination budget is much less this year. Finance Secretary T.V. Somanathan told Business Standard that if the need arises, the centre would provide more funds later in the year for any scheme or requirement. For the revised estimates of FY22, fiscal deficit is seen at 6.9% of GDP compared with the budget estimate of 6.8%. However, top officials, including the Finance Minister, have admitted that the centre has been very conservative in terms of what it expects from the Life Insurance Corporation initial public offering. If the IPO is a success, then the centre could very well meet its original fiscal deficit target for the current year.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.